All right, today we're diving into J.Jill's second quarter earnings. And wow, what a report. This thing sent the stock on an absolute roller coaster. And honestly, it left a lot of investors scratching their heads. So let's break down exactly what happened. So here's the big question, right? J.Jill comes out, they beat earnings estimates. So you'd think, great, stock goes up. But nope. Instead, the stock tanks 8%, only to then rally all the way back and close up 2%. What in the world is going on here? That's what we're going to figure out. Okay, first up, A beat, dip, and rally. We're going to unpack the market's really mixed signals from that day. I mean, look at this. The reversal was just stunning. Before the market even opened, J.Jill's stock was already down over 8%. So the initial reaction, totally negative. But then, as the day went on, and on trading volume more than double the average, by the way, the buyers just flooded in. The stock rallied all the way back to finish in the green. So what did those later buyers see that the early sellers completely missed? To solve this puzzle, we have to move past the stock chart and really dig into the numbers, separating the headlines from the headwinds. The story here is a classic case of what the company reported versus what the market feared. So let's start with the good news, because there was plenty of it on the surface. First up, earnings per share. J.Jill reported an adjusted EPS of 81 cents. That's a solid beat of 5 cents over what Wall Street was expecting. You know, on its own, that's a really positive signal. And it wasn't just on the bottom line either. The top line also came in strong. We're talking total revenue of $154 million, which beat the consensus by a really healthy $4.5 million. So you've got beats on both revenue and earnings. You'd expect a party, right? But that's not what happened, at least not at first. So why the huge initial drop? Well, because the smart money, the sophisticated investors, they immediately looked past those headline beats. They started digging into the underlying metrics and, maybe more importantly, the company's guidance for the future. And what they found? Yeah, there were some very real reasons to be concerned. And here are the trouble spots that really spooked the market. First, gross margin. It fell by 210 basis points. Now, all that means is the company was making less profit on every single dollar of sales. Why? Well, partly because they had to run more promotions to clear out inventory. Then you have comparable sales. That's how you measure performance at existing stores. And those were down 1%. And even the direct-to-consumer business, which everyone watches closely, saw its share of the pie shrink. These are the kinds of underlying weaknesses that trigger that big 8% pre-market sell-off. So what on earth caused the stock to rally all the way back? Well, 2 words: new CEO. As the day went on and the market had time to really digest the earnings call, the focus shifted to Mary Ellen Coyne. This was her first full quarter in charge, and people started paying attention to her new strategic plan. This really became the story of hope that fueled the stock's big recovery. And her plan is actually really clear. It's a 3-pronged strategy. First, evolve the product. Widen its appeal, expand into new things like accessories. Second, enhance the customer journey. This means overhauling their marketing. They even tested a small TV ad that they said had a tremendous impact. And finally, just improve how they work. Embrace technology, get more efficient. They even launched ship from store ahead of schedule, which is a great sign. And this quote from the CEO really gets to the heart of it all. What she's saying is this whole strategy, it's all about one thing: customer growth. Attracting new ones, re-engaging old ones, and keeping the loyal ones happy. This clear, confident vision gave investors a reason to believe that, hey, despite the short-term problems, the new leadership has a real plan. And that's likely what turned the tide on the stock. But, there was one major headwind that even the best strategy couldn't just wish away: tariffs. And this became the single biggest negative that came out of the company's guidance for the next quarter. The company put a number on it, and it's a big one. An estimated $5 million hit from tariffs in the third quarter alone. For a company the size of J.Jill, that is a massive direct blow to their profitability, and it's really the main reason their Q3 guidance was so weak. And the reason the impact is so severe is because the cost environment just changed so dramatically and so fast. Management explained that their old plans were based on a 10% tariff rate. Well, now, the average rate for their biggest sourcing countries is closer to 20%. And for India, a really key supplier for them, the rate has shot up to a whopping 50%. This just shows you how quickly the whole game has shifted against them. Now, to be clear, management isn't just sitting there and taking this hit. They're actively trying to soften that $5 million blow. They're talking with their suppliers, adjusting future orders, and taking a hard look at their own pricing and promotions. The big question for investors is, how much of that $5 million can they actually claw back? Okay, so let's put this all together. What should we expect to hear from J.Jill on their next earnings call? Based on everything we've seen, we've put together our own prediction and our official rating. So here's our take. We expect J.Jill to report at the lower end of their guided range. Look, management is pulling the right levers, but that $5 million tariff headwind is it's significant. Plus, they themselves noted that they're not sure how customers will react to higher prices. Given how price-sensitive everyone is right now, we think comparable sales will probably fall in that mid-single-digit range. And that would bring their adjusted EBITDA in at around $19 million. And all of this brings us to our final rating on J.Jill, market perform. It's really a tale of two stories. The bull case is clear, right? You've got a new focused CEO with a solid turnaround plan. They generate strong cash flow and they're focused on shareholders. But the bear case is just as clear. You've got these severe margin pressures from tariffs and a consumer who is being really cautious. For now, those two forces feel pretty balanced, which is why we're neutral. We really need to see some proof that the new strategy is starting to win against these bigger economic pressures. So the key takeaway here, J.Jill's wild trading day was really a battle between worrying short-term numbers and some real optimism for a long-term turnaround. The big question for next quarter is, which story is going to win? And as always, this is not financial advice.